Hello, in this segment of the course, we're going to explore the role of the government in the economy. We want to know, how can the Federal Reserve, or for the federal government, such as Congress, affect economic outcomes? Well, there's two ways that they can affect what's going on in the economy, either through government spending or through taxes. These two factors also directly affect the government's budget. So when there's a change in government spending or a change in taxes, it'll affect economic outcomes through a change in G, in our aggregate demand, or through a change in consumption as people pay more or less taxes. But also, it's going to affect how much money the government has available to spend on goods and services. So when we think about government spending, this is going to depend on tax revenue. If the taxes that the government collects is greater than the amount that it spends on goods and services, then the government is running a budget surplus. It's essentially collecting too much money from its constituents in the form of taxes. It's not spending all of it. So, another option is that if the taxes that it's collecting are less than government spending, then they are running a budget deficit. So with a budget surplus, taxes greater than government spending, they're collecting too many taxes. And they're not spending all of them. On the other hand, when taxes are less than government spending, they're not collecting enough taxes to cover their spending. Their tax revenue is not high enough to meet and pay for all of the goods and services that the government is buying. So therefore, if the government runs a budget deficit where taxes are less than government spending, it needs to find a way to finance that deficit. And the way that they do that is through borrowing money, through issuing government bonds. So if taxes are less than government spending, and the government has to finance that deficit through issuing bonds, this is going to affect the national debt. The national debt reflects the accumulated amount of money borrowed by the government to finance its spending activity. So what we see is that the national debt accumulates the debt that the government has accrued over years. So the more that the government is in debt, the larger the national debt number is going to be, because it compounds year over year. So the longer the government runs a budget deficit, the more the national debt grows. So when we think about government spending, the government spends on a local, state, and national level on a number of things, such as national defense or the military, on education, such as paying its teachers and paying for schools, infrastructure, such as building bridges and repairing roads, and transfer payments or welfare payments. So when we think about transfer payments and welfare payments, these we do not include of what we call government spending that affects aggregate demand. So even though the government spends money on transfer payments and welfare payments, they're not considered a transaction by the government. It's a transfer of funds from the government to individuals that need assistance from the government through the government-sponsored programs. But the government is not getting anything in exchange from that. So when we think about the payment the payment or the transfer of money from the government to individuals through the welfare system, we do not account for that in G, government spending, that affects aggregate demand. Next, we want to talk about taxes. Well, there's a number of different taxes that are put into place in an economy, such as corporate taxes, which are taxes that are paid by businesses, sales taxes that are paid by both businesses and consumers based on the amount of goods and services that are sold, personal income taxes that are paid by the household based on the income that you generate, property taxes also paid by households that own their own homes, and other taxes such as taxes on hotel, sin taxes that includes taxes on alcohol, and cigarettes, and an estate tax, which after someone passes away, the remaining funds that are left on their estate, they would have to pay out tax on that. So the types of taxes that we have are a progressive tax or a regressive tax. So this tells us how the tax influences the equality of how it is being distributed and paid for. With a progressive tax, the tax is increasing as the taxable amount increases. So the tax rate progresses from low to high. So what this means is that people that are wealthier are going to pay a higher tax than people that are poorer or have lower incomes. On the other hand, if we look at regressive taxes, the tax is imposed in such a manner that the tax rate decreases as the amount subject to the tax increases. So this affects, the distribution effect on income or expenditure progresses from high to low. So the average tax rate exceeds the marginal tax rate. So essentially, with a regressive tax, what this is telling us is that people that are wealthier are going to be paying less than people that are poorer. So when we're thinking about fiscal policy, the government can influence economic activity through fiscal policy by changing government spending or changing taxes and determining how that affects aggregate demand. So government spending is part of the aggregate demand curve, remember, which is part of C plus I plus G plus NX, net exports. Taxes, on the other hand, are going to affect consumption. People have a total amount of income that they generate from the jobs that they take on. Part of that income has to be paid in taxes. The remaining amount is what we call disposable income. So if tax rates are higher, all else equal, the amount of disposable income that households have is going to be lower. So they're not going to be able to spend as much on goods and services. Consumption will be lower. On the other hand, when taxes are lower, then all else equal, your disposable income is going to be higher because less of your income is going to taxes. Therefore, you have more of your income available to spend on goods and services that you want to buy. So if income taxes are high, consumption will be low. If income taxes are low, consumption will be high. So taxes affect aggregate demand indirectly through their impact on consumption. So if the government is thinking about stimulating growth, what it wants to do is to boost the economy from a low growth phase. What it needs to do is to enact fiscal policies that would increase aggregate demand in the short run. It can do this by increasing government spending, decreasing taxes, or both, increasing government spending and decreasing taxes. So let's take a look at an example. So suppose the economy is in a low growth phase and the government wants to stimulate growth. So let's say we start off at a point such as point A, where here we have the price level at P1 and real GDP at Y2, output 2. So we want to know what happens if the government boosts infrastructure spending by $20 billion and cuts the personal income tax from 30% to 25%. Well, what this tells us is, number one, a boost in spending on infrastructure by $20 billion translates to an increase in government spending or an increase in aggregate demand. Two, a decrease in taxes tells us that people have more money in their pocket to spend on goods and services, telling us we'd have an increase in consumption and therefore an increase in aggregate demand. So a combination of cutting taxes and increasing in infrastructure spending would lead to a shift in the aggregate demand curve out or to the right. The result, therefore, is that we move to a new equilibrium point, such as equilibrium B, in the short run, which corresponds to P2 for the price level and Y2. So what has the government done through its fiscal policy that stimulates growth? Well, it leads to an expansion in production. Real GDP has increased temporarily in the short run. And we also see an increase in the price level, telling us that the influence of this government policy, of this fiscal policy that has led to an increase in government spending and a cut in taxes that has stimulated consumption spending, well, we also see that though this has stimulated growth, it has also introduced inflation in our economy. So what we see, though, is that low growth corresponds to high government deficits, because notice the combination that we have here. Government spending has increased and taxes have fallen. So even if we start at a point where government spending is equal to the tax revenue, if government spending increases but taxes fall, then automatically we move to a place where government spending is greater than the tax revenue generated. So we see that when we have low growth in the economy and the government is trying to stimulate the economy through fiscal policy to expand production and shift the aggregate demand curve, this is going to correspond to higher government deficits. So the boost from the stimulating fiscal policy will lead to the higher inflation and to higher production growth, which will correspond to lower unemployment. So this is just an introductory example into fiscal policy and how it affects the aggregate economy. We're going to spend a lot of time in the coming segments really dissecting the influence of fiscal policy and the sizes of the shift in aggregate demand when we have what we call the multiplier effect as well as the crowding out effect when we see a change in government spending. We'll also spend some time discussing the influences of government policies on inflation and unemployment. So this is just an introduction to give you an idea of how government spending, specifically how changes in fiscal policy, can affect the aggregate economy. And we'll be spending much more time dissecting this in the coming segments. So be sure to stay tuned for those. And also take a look at your textbook to be sure to read in greater detail about taxes, government spending, and the national debt. Thanks so much for joining me.